Hi everyone, I'm James. TSMC just released its earnings numbers recently. The numbers look great, but one number caught my attention. Let's start with the headline numbers. TSMC delivered another exceptional quarter. Revenue increased 33.7% year-over-year to 40.2 billion, while earnings per share surged 77.4% compared with the same period last year. Profitability also continued to improve. Gross margin reached 67.7%, operating margin climbed to 60.3%, and net profit margin increased to 55.6%. Management also raised its full-year outlook, now expecting 2026 revenue growth of slightly more than 40%, compared with its previous expectation of around 30%. By almost every measure, this was another outstanding quarter. But one number stood out. Despite earning significantly more money, free cash flow declined. The reason was not weaker operations. Operating cash flow actually continued to grow. Instead, TSMC spent even more on capital expenditure than the additional cash it generated. In other words, the company is not just making more money, it's investing even faster. And I think that is the most interesting part of this annual report. Why is one of the world's most disciplined capital allocators suddenly accelerating investment so aggressively? The headline earnings were impressive, but the biggest signal from this quarter was TSMC's capital expenditure. Management increased its 2026 capex guidance from 52 to 56 billion to 60 to 64 billion. That's roughly an additional $8 billion of investment announced in just one quarter. For many companies, higher capital spending would not be unusual. But TSMC has historically been extremely disciplined when expanding capacity. The company has rarely invested aggressively simply because demand is strong today. Instead, it expands when management has confidence that future demand will justify the investment. And this quarter suggests something has changed. Management said capital expenditure over the next 3 years will be significantly higher than the previous 3 years. This is not a temporary increase. It represents the beginning of a much larger investment cycle. So why is TSMC accelerating investment? Management explanation was simple. Customers are asking for more capacity. During the earnings call, management highlighted strong demand signals from both direct customers and their customers. They also explained that the high investment reflects the need to bring new capacity online faster, while also dealing with higher equipment costs. The important point is this. TSMC is not investing based on speculation, it's investing in response to customer demand. The company believes its customer will need significantly more advanced semiconductor capacity in the years ahead. This increase in capital expenditure also reflects a major shift in TSMC's business. Historically, growth was driven largely by consumer electronics, especially smartphones. This market remain important, but they are naturally cyclical because demand depends on consumer upgrade cycles. Today, the demand profile looks very different. High-performance computing now accounts for 66% of TSMC's revenue, up from around 40% 3 years ago, while smartphones have declined to around 22%. The center of demand have shifted from consumer devices to AI infrastructure. This doesn't mean that AI demand is immune from cycles, but it does suggest this investment cycle is being supported by a broader structural trend. Management's action also reflects a long-term view. This quarter marked the first meaningful revenue contribution from 2nm technology, showing TSMC is already moving into its next generation of manufacturing. But leading-edge semiconductor technology takes years to develop. New processors, fabs, and customer qualification require massive investment long before significant revenue arrives. TSMC's expansion in Arizona is another example of this strategy. The additional $100 billion investment will support key customers while reducing geopolitical concentration risks. Although overseas manufacturing may pressure margins, TSMC appears willing to accept that trade-off for greater resilience and stronger customer relationships. Together, these investments show that TSMC is not simply building more factories, it's building the infrastructure it believes will support the next phase of AI growth. So why does all of this matter? Because for TSMC, capital expenditure is not just an expense, it is a signal. The logic is simple. Customer demand drives capacity decisions. Capacity decision drives capital expenditure. And that new capacity eventually creates future revenue and earnings. Historically, TSMC has only expanded aggressively when management has strong confidence that future demand will justify the investment. And this quarter, we saw one of the clearest signals yet. TSMC is not only reporting record earnings, it is committing to one of the largest investment cycles in its history because management believes customers will require significantly more advanced capacity in the future. That makes capital expenditure much more than an accounting number. It is management's view of where the industry is heading. The key question is not whether TSMC had a strong quarter. It clearly did. The bigger question is whether today's AI infrastructure spending can justify the massive amount of capacity being built across the semiconductor industry. If management is right, today's record investment could become tomorrow's revenue growth and earnings expansion. But if AI demand slows significantly, investors may begin questioning whether the industry has overbuilt. Ultimately, this quarter was not just about earnings, it was about confidence. TSMC is committing tens of billions of dollars today for capacity that may not generate meaningful revenue for years. In an industry where leading-edge technology takes years to develop and commercialize, this may be the clearest signal of how management views the future of AI demand. I hope this is helpful for you. Stay focused, everyone, and I'll see you next time.